Reconciliations are one of the most important skills new accountants learn and are often among the first responsibilities you're entrusted with when you join a company. I've personally prepared hundreds of bank reconciliations and reviewed thousands of them. It's safe to say that some bank reconciliations are straightforward, while others are quite complex, depending on the number of transactions, sometimes thousands per month. Split deposits for credit cards, especially timing differences, and items such as electronic transfers, errors, chargebacks, and bank fees. Every business has at least one bank account, and many have several. And I've worked for companies with over 100 bank accounts. Now, why so many? One reason is that companies like to maintain separate accounts for customer receipts, vendor payments, and payroll. Another reason is that some companies need specific accounts for international transactions, and not all banks offer international transactions or accounts in foreign currency. A third reason is that companies often set up separate accounts for each legal entity to maintain clear financial boundaries and reduce legal exposure. Whether a business has one bank account or more, the goal is the same. The cash balance in the company's accounting records must agree with the balance reported by the bank. And when there are differences, accounts must identify, be able to explain them, and resolve them. In addition, bank reconciliations are an important internal control that detect errors, omissions, timing differences, and occasionally even fraud. In this video, you'll learn how the bank reconciliation process works and how accounts identify and resolve differences between the company's records and the bank statement. The bank reconciliation process can be broken down into 6 basic steps. First, gather the necessary documents, including the bank statement and the company's cash account activity from the general ledger. Next, compare the deposits on the bank statement to the deposits recorded in the accounting records. Then compare the withdrawals and payments such as checks, electronic transfers, debit card transactions, and bank fees to the amounts recorded in the general ledger. Once all transactions have been compared, reconcile the ending balances by identifying any timing differences such as outstanding checks or deposits in transit. Then investigate and resolve any discrepancies, including missing transactions or recording errors. Finally, make any necessary adjusting journal entries to ensure the accounting records accurately reflect the company's cash position. While these steps may sound straightforward, the real challenge is identifying and explaining the differences between the bank's records and the company's records. So let's walk through the process together using our textbook example for Max Out Sporting Goods. The first step in the bank reconciliation process is gathering the necessary documents. And one of the documents is the bank statement. Each month, the bank provides a statement that summarizes the deposits received, checks paid, electronic transactions, and the ending balance for the account. And this is the bank statement for Max Out Sporting Goods. This statement was issued by First Texas National Bank and identifies Max Out Sporting Goods as the account holder. We can also see the account number and that the statement is for January. The statement shows the beginning balance on January 1st of $12,025.50, total deposits and credits of $37,672, and total withdrawals and debits of $25,189. This results in an ending balance of $24,508.50. Below the summary section, the statement provides the detailed activity, the deposits, and withdrawals by date. In today's business environment, most companies monitor their bank accounts daily through online banking apps rather than waiting for the monthly statement. Incoming customer payments, wire transfers, and electronic payments often need to be recorded promptly so that invoices can be cleared, orders can be shipped, and account balances remain accurate. Daily monitoring also helps companies identify unauthorized transactions or bank errors as quickly as possible. Another area that I've always paid attention to was credit card disputes, because you want to make sure that you don't ship anything else to a customer that just disputed their credit card charges that they received merchandise or services for. So paying attention to all the daily activity is very important, and you definitely can't wait until the end of the month when the statement is generated by the bank. So if companies can see their account activity online every day, why is the bank statement so important? The bank statement serves as the bank's official record of the account activity and ending balance for the period. It provides independent evidence of the company's bank balance and is a key document used during audits. Auditors will often request bank confirmations directly from the bank and review both the bank statement and the related bank reconciliation. And many accounting systems can now import bank activity automatically and assist with the reconciliation process. However, accountants still need to review the transactions, investigate differences, and ensure that the company's records accurately agree with the bank's records. Whether the reconciliation is automated or performed manually, the accountant remains responsible for the final result. The second document we need for the bank reconciliation is the general ledger detail for the cash account from the company's accounting records. While the bank statement shows the transactions recorded by the bank, the general ledger shows the transactions recorded by the company. This is the general ledger detail for our textbook example, Max Out Sporting Goods. In this report, we can see 5 basic columns: the date of the transaction, the description, debits and credits, and the running balance. You can see the beginning balance of $12,025.50, debits for the deposits of $42,612, and the credits for the payments of $38,576.80 with an ending balance of $16,060.70. Depending on the accounting software being used, the company may have additional information such as reference numbers, customer names, vendor names, or transaction IDs. However, the information shown here is the minimum detail needed to perform a bank reconciliation. As the accountant, your goal is to compare the transactions recorded in the company's books to the transactions recorded by the bank. Any differences between the two records must be identified and explained. And that's why both the bank statement and the general ledger detail are essential documents for the reconciliation process. As we work through this example, you'll see that most transactions appear in both records, but some transactions may appear in only one record because of timing differences, omissions, or errors. Identifying those differences is what allows us to complete the reconciliation. Now that we have the bank statement and the general ledger side by side, we can compare the two records to identify any difference. First, let's start with the ending balances. The cash account in the general ledger shows an ending balance of $16,060.70 as of January 31st. The bank statement shows an ending balance of $24,508.50, and that's a difference of $8,447.80. And to understand why there is a difference, we compare the deposits first. The general ledger shows total deposits of $42,612, while the bank statement shows total deposits and credits of $37,672. At first glance, it appears that the bank is missing some deposits. Looking more closely, we can see that the last deposit recorded on the bank statement is $836. However, the general ledger shows an additional deposit of $5,940 on January 31st that does not appear on the bank statement. This difference is known as a deposit in transit. A deposit in transit occurs when the bank records a deposit in its accounting records, but the bank has not yet processed or recorded it by the statement date. This is very common near the end of the month because deposits made late in the day or on the last business day may not be reflected by the bank until the following month. To verify that this is simply a timing difference, let's add the deposit in transit to the bank's deposit total. And the bank statement shows deposits of $37,672, adding the $5,940. Deposit in transit gives us total deposits of $43,612. However, the general ledger still shows only $42,612 in deposits. That means there is still a difference of $1,000 that we need to investigate. As we will see, identifying and explaining these remaining differences is the heart of the bank reconciliation process. As we continue comparing the deposits, we're still looking for the remaining $1,000 difference between the bank statement and the general ledger. Scanning the deposits listed on the bank statement, we find the $1,000 deposit dated January 31st. However, when we look through the general ledger detail, we do not see a corresponding $1,000 deposit recorded in the company's books. Whenever a transaction appears on the bank statement but not in the accounting records, the next step is to investigate the source of the transaction. And after performing a little research, we discovered that the bank deposited $1,000 into Max Out Sporting Goods account as loan proceeds. The bank has already recorded the deposit, which is why it appears on the bank statement. However, because the company has not yet recorded the transaction in its accounting records, the account in the general ledger is understated by $1,000. Now, unlike a deposit in transit, which is simply a timing difference, this item requires an adjustment to the company's books. Max Out will need to record the receipt of the loan proceeds so that its accounting records agree with the bank records. This is a common occurrence during a bank reconciliation. Sometimes the reconciliation process uncovers transactions that the bank has recorded, but the company has not yet entered into its accounting system. Those items typically require adjusting journal entries. Now let's compare the withdrawals and identify any remaining differences between the bank statement and the general ledger. To make the comparison easier, I've placed a check mark next to every transaction that appears in both records for the same amount. For example, check 111 appears as $1,500 in both the general ledger and the bank statement. So we know that this item has cleared the bank and does not require any further investigation. Now, after comparing all of the withdrawals, I noticed that checks 124, 125, 126, 127, 128, 129, and 130 are recorded in the company's general ledger, but do not appear on the bank statement. These items are called outstanding checks. An outstanding check is a check that has been issued and recorded by the company, but has not yet been presented to the bank for payment. These checks will most likely clear and appear on the next month bank statement. Next, let's look at the items that appear on the bank statement but cannot be found in the company's records. The first item is a withdrawal of $1,600 dated January 22nd and identified as check 10087. This check number does not follow the numbering sequence used by Max Out Sporting Goods, which suggests that it does not belong to the company. This appears to be a bank error. Because the bank incorrectly charged Max Out's account, the company should contact the bank and request that the error be investigated and corrected. Since the company did not issue this check, no journal entry is needed at this time. The remaining two items are returned customer check for $525 and a bank service charge of $25. These transactions have been recorded by the bank but have not yet been recorded in the company's accounting records. The returned customer check, sometimes called a bounce checks or NSF for non-sufficient funds check, means that a customer's payment was originally deposited but was later rejected by the customer's bank. As a result, MaxOut must reduce its cash balance and reestablish the amount owed by the customer. The $25 service charge is a fee assessed by the bank for maintaining the account or processing transactions. Since the company has not yet recorded this expense, it will need to be added to the accounting records. At this point, we have identified all the differences between the bank statement and the general ledger. We know which items are timing differences, which items require journal entries, and which items represent a bank error. And now we're ready to prepare the bank reconciliation. Before we prepare the bank reconciliation, let's recap the most common reasons why the cash balance in the company's accounting records does not agree with the balance shown on the bank statement. The first reason is outstanding checks. These are checks that have been issued and recorded in the company's general ledger but have not yet cleared the bank. For example, a company may issue several checks on the last day of the month, but the recipients may not deposit or cash them until the following week. And as a result, the checks appear in the company's records but not yet on the bank statement. The second reason is deposits in transit. These are deposits that have been recorded by the company but have not yet been processed by the bank. For example, a deposit made late on the last day of the month may not appear on the bank statement until the next business day. The deposit is included in the company's books but not yet reflected by the bank. The third reason is bank transactions that the company has not yet recorded. These often include service charges, NSF checks, electronic payments, automatic withdrawals, interest earned, or other bank activity that appears on the bank statement before the company has recorded it in the accounting records. These items typically require adjusting journal entries. The fourth reason is deposits or credits recorded by the bank but not yet recorded by the company. For example, in our MaxOut Sporting Goods example, the bank deposited $1,000 of loan proceeds directly into the company's account. Because the company had not yet recorded the transaction, the bank balance and the book balance did not agree. As you can see, most differences arise because one party, the bank or the company, has recorded a transaction before the other. The purpose of the bank reconciliation is to identify these differences, determine their cause, and ensure that both records accurately reflect the company's cash balance. And we're ready to start this bank reconciliation. This is a common type of format for bank reconciliations. It shows the name of the company on the first header line, bank reconciliation statement on the second line, and the end of the month for which we're reconciling the bank balance. There are two main sections for the bank reconciliation. The first section starts with the balance on the bank statement and then adds and subtracts adjustments. For instance, we would add deposits in transit and we would subtract outstanding checks. That leaves us with the adjusted bank balance. The second section starts with the ending balance in the general ledger and then adds and subtracts adjustments. For instance, we would add amounts that appear as additions on the bank statement that have not yet been recorded in the general ledger, and we would subtract adjustments that appear as subtractions on the bank statement that have not yet been recorded in the general ledger. That leaves us with the adjusted book balance, or our textbook calls it balance in books, but most reconciliations that I've worked with used adjusted book balance. Let's start with the process of reconciling the balance by entering the ending bank balance of $24,508.50 into the top section of the reconciliation on the line that says balance on bank statement. In the second section labeled Balance in Books, we'll enter the ending balance from the cash account in the general ledger. Looking at the general ledger detail for Max Out Sporting Goods, the ending cash balance as of January 31st is $16,060.70. This amount represents the company's recorded cash balance before any reconciliation adjustments have been made. And as we identified earlier, there are several transactions that appear on the bank statement but have not yet been recorded in the company's books. We'll account for those items in this section of the reconciliation. For now, enter the general ledger ending balance of $16,060.70 on the line labeled Balance in Books. Once we add and subtract the necessary adjustments, we'll arrive at the adjusted book balance. Now we begin the adjustment portion of the reconciliation by continuing with the bank section at the top of the reconciliation. Remember, the purpose of the bank section is to adjust the bank statement balance for items that the company has already identified, but that the bank has not yet properly reflected. These are items that we expect the bank to process or correct in the future. In the additions section, we enter the amounts that will increase the bank balance. So one example is a deposit in transit. We know that Max Out recorded a deposit of $5,940, but the bank had not yet processed it by the statement date. Because we expect the bank to record this deposit shortly, we add it to the bank statement balance. We also add the $1,600 bank error that we identified earlier. Recall that the bank charged Max Out's account for check number 10087, even though the check did not belong to Max Out Sporting Goods. Since the bank incorrectly reduced the account balance, we expect the bank to investigate and correct the error. Therefore, we add the $1,600 back to the bank side of the reconciliation. So in the additions section, we entered the $5,940 deposit in transit and $1,600 bank error. These items increase the bank balance because they represent amounts that we expect the bank to recognize and correct in the future. Next, we'll complete the deductions section of the bank portion of the reconciliation. The deductions consist of the outstanding checks we identified earlier. And remember, these are checks that have already been issued and recorded in the company's accounting records, but they have not yet cleared the bank. Since we expect the bank to process these checks in the future, we must reduce the bank statement balance by their amount. Now, in this example, the outstanding checks are checks 124 through 130. Together, these checks total $15,537.80, and we entered this amount in the deductions section of the bank reconciliation. Now we can calculate the adjusted bank balance. We start with the ending bank statement balance of $24,508.50. We then add the reconciling items in the addition section totaling $7,540, which consists of the $5,940 deposit in transit and the $1,600 bank error. Finally, we subtract the outstanding checks totaling $15,537.80, and after making these adjustments, we arrive at an adjusted bank balance of $16,510.70. At this point, the bank side of the reconciliation is complete. Next, we'll turn our attention to the book side and make the adjustments necessary to bring the company's accounting records to the same adjusted balance. Now we're ready to move to the second section of the bank reconciliation, which focuses on adjusting the company's book balance. Recall that this section includes transactions that have already been recorded by the bank but have not yet been recorded in the company's accounting records. Since these items affect the company's cash balance, they must be added to or deducted from the book balance. So let's begin with the additions section. Earlier, we identified a $1,000 deposit on the bank statement that did not appear in the general ledger. And after investigating the transaction, we determined that the bank had deposited $1,000 of loan proceeds directly into the Max Out Sporting Goods bank account. Because the bank has already recorded the deposit, but the company has not yet recorded it in its accounting records, we need to add this amount to the book side of the reconciliation. Therefore, we enter a $1,000 loan deposit in the addition section. This adjustment increases the company's book balance and brings the accounting records one step closer to agreeing with the adjusted bank balance. Next, we'll complete the deductions section of the book side of the reconciliation. These deductions represent amounts that were correctly recorded by the bank but have not yet been recorded in the company's general ledger. Because the bank has already reduced the account balance for these items, we must also reduce the company's book balance. In this example, we identified two such items. The first is the NSF check for $525. And recall that this was a customer check that was originally deposited but was later returned by the customer's bank due to insufficient funds. The second item is the $25 bank service charge that the bank deducted from the account during the month. We enter both amounts in the deduction section of the reconciliation, and together they reduce the book balance by $550. And now we can calculate the adjusted book balance. We start with a general ledger balance of $16,060.70 at the $1,000 loan deposit that had not yet been recorded, and subtract the NSF check and the service charges totaling $550. This results in an adjusted book balance of $16,510.70. And notice that the adjusted book balance of $16,510.70 agrees exactly with the adjusted bank balance of $16,510.70. When the two adjusted balances agree, the bank reconciliation is complete. If the balances do not agree, you must continue investigating until all differences have been identified and properly accounted for. One final and very important reminder, completing the bank reconciliation alone is not enough. Any items used to adjust the book balance must also be recorded in the company's general ledger. In our example, that includes the $1,000 loan deposit, the $525 NSF check, and the $25 bank service charge. Recording these journal entries is the final step in the reconciliation process and ensures that the company's accounting records are accurate and up to date. The final step in the bank reconciliation process is to record any necessary adjusting journal entries. Remember, we only prepare journal entries for items that affect the company's accounting records. We do not record journal entries for outstanding checks, deposits in transit, or bank errors because those items will be resolved by the bank in a future period. In this example, we need to record two journal entries. The first journal entry records the NSF check and the bank service charge when David Newhouse's check was returned by the bank. The company no longer had valid payment for the amount owed. Therefore, we need to increase accounts receivable by debiting accounts receivable and the David Newhouse subsidiary account for $525. We also record the $25 bank service charge by debiting bank fees expense. Finally, we credit cash for the total reduction in the bank account of $550. The second journal entry records the $1,000 loan proceeds that were deposited directly into the bank account by the bank. To record this transaction, we debit cash for $1,000 because the company's cash balance increased. Cash is an asset account, and asset accounts increase with debits. We then credit notes payable for $1,000. Notes payable is a liability account, and liabilities increase with credits. This entry records both the increase in cash and the company's obligation to repay the loan in the future. Once these journal entries have been posted to the general ledger, the company's accounting records will reflect all of the transactions identified during the reconciliation process. At that point, the adjusted cash balance in the general ledger will agree with the adjusted balance shown on the bank reconciliation, completing the process. Bank reconciliations help ensure that a company's most important asset, cash, is reported accurately. By identifying timing differences, correcting errors, and recording necessary adjustments, accountants can be confident that both the bank records and the company records agree. As you continue your accounting studies, you'll find that the examples may become more complex, but the goal remains the same. Explain the differences, reconcile the balances, and ensure the accounting records are accurate.